The market can be kind to those who don't deserve it, cruel to those who do, and unfair about how money is spread around, so nothing is ever written in stone. Last December, we made our predictions about which stocks would be the riskiest places for your money. Now we're ready to update you on how those stocks are doing. Did we foresee doom in companies that didn't deserve it, or were we right to write them off before they took bigger losses? Read on to find out. 1. Research in Motion NASDAQ RIM. Well, thank you for trying Verbose. This recording will go away once the product has been purchased. We said then, gone are the days of BlackBerry or bust, when every enterprise in town equipped employees with the addictive black smartphone. Lately, Research in Motion's stock price has hovered around a 6-year low. In its latest earnings report, RIM said it expected revenue of between $4.6 billion and $4.9 billion, lower than analysts' already low expectation of $5 billion. The company also announced it planned to ship between 11 million and 12 million BlackBerry units, where analysts were hoping for 13 million. Citi analysts reacted to the report with a sell recommendation, and predicted that RIM would miss targets for thank you for trying Verbose. This recording will go away once the product has been purchased. Both holiday sales and Back to School 2012, according to the Wall Street Journal. Does management even know what's happening? Not so much, according to a letter written by a high-ranking employee bemoaning that management is disconnected with the realities of the mobile industry and out of touch with how low the morale of its employees has dipped, according to CNET. Instead of launching new smartphones during the first 6 months of 2011, RIM concentrated on its Playbook tablet, which failed to the tune of $485 million in losses. RIM isn't offering a much-needed thank you for trying Verbose. This recording will go away once the product has been purchased. Tablet OS upgrade until February 2012, instead favoring extracurricular activities like helping police hunt down British rioters. Perhaps RIM's upcoming PBX mobile platform will be a hit, but, given its recent track record, that's a questionable bet. What happened? We got it pretty much right with Research in Motion. The company's year-to-date stock performance is down 44.10% so far, and there's little to indicate that things will get better. Hard details about RIM's upcoming BlackBerry 10 were missing from September's smartphone announcements, which may show the company's lack of faith in its ability to compete with thank you for trying Verbose. This recording will go away once the product has been purchased. The Infinity 5 NASDAQ AAPL and Google's NASDAQ GOG new suite of Androids. Right now the BlackBerry 10 is rumored to be released sometime in January, well after most of the major smartphone releases, and the best any major outlet has been able to say about it so far is that it will focus on the keyboard. Although the company seems to have given up on its tablets, its executives still seem disconnected with the market as they haven't realized the importance of building a strong app database. In comparison, Microsoft NASDAQ MSFT has been slowly building an app thank you for trying Verbose. This recording will go away once the product has been purchased. Database, and as a result its Windows Phone has been stealing market share from RIM. 2. Focus Media Holding NASDAQ FMCN. What we said then, if you see a flat panel LCD in China, chances are the screen is owned by Focus Media Holding, China's biggest lifestyle-targeted digital media company. But if the recent independent investigation of the advertising giant holds water, FMCN's ads might as well be saying, we lied. The research firm Muddy Waters issued a critical report in November 2011, accusing Focus Media of a host of fraudulent thank you for trying Verbose. This recording will go away once the product has been purchased. Activities, including overstating the number of LCD screens it owns by 50%. Claiming to own and dispose of companies it never actually purchased, writing down more than 20 acquisitions to zero and giving them away, and insider trading to the tune of $1.7 billion. After Muddy Waters released the report, rating the stock a strong sell, Focus Media's stock fell 40%. Focus Media officials wrote an elaborate rebuttal to Muddy Waters' report, so the question of corruption hasn't yet been settled. Still, for the time being, Focus Media has put a spotlight on cronyism in thank you for trying Verbose. This recording will go away once the product has been purchased. China, the fallout remains to be seen. What happened? Muddy Waters is still on Focus Media Holdings' case, but the company has been experiencing a string of good luck lately. Its stock is up 21.29% for the year amidst rumors of going private and programs to buy back shares from investors. In August, the company was allegedly offered a $3.49 billion buyout from the Carlyle Group, though the deal has yet to take place. There is still some speculation on whether or not the company has been fudging its numbers, so you may be wise to thank you for trying verbose. This recording will go away once the product has been purchased. Stay away, but some analysts believe that short selling might be the way to go right now. 3. Jefferies & Company NYSE, Jeff. What we said then, when MF Global Inc. MFGLQ made $6.3 billion in repurchase agreement repos with indebted European nations, including Ireland, Italy, Spain, and pause rule, it was, despite the European disaster, supposed to be a low-risk investment. It appears, however, that MF Global's counterparties reneged or made untenable demands on the agreements, according to the Financial Times. As a result, MF Global, facing a liquidity shortfall, used more than $890 million in thank you for trying verbose. This recording will go away once the product has been purchased. Segregated customer funds to cover its losses, and then filed for bankruptcy. Customers, needless to say, were not happy. That brings us to New York-based investment bank Jefferies & Company, which, like MF Global, the former investment has exposure to European debt. Amid investor jitters, the company disclosed that its net European exposure was only about $90 million, and that it does not have any repo-to-maturity activity. After the MF Global fiasco, Jefferies also diminished its sovereign debt holdings in Italy, Ireland, and Portugal by nearly 50%, according to some folios. Jefferies, thank you for trying verbose. This recording will go away once the product has been purchased. It has since released an earnings report that reassured investors the firm had cut exposure to European sovereign bonds by $4.3 billion, or 82.5%, since early November, according to Reuters. Although the company paid for the defensive moves, reporting weaker profits and revenues, investors welcomed the decision to reduce risk. The stock price rose nearly 23% in trading the day earnings were announced. What happened? So far, the assertions of Jefferies & Company seem pretty trustworthy. The company is up 2.55% for the year. The European market also seems to be doing better lately, so perhaps the thank you for trying verbose. This recording will go away once the product has been purchased. Company's investments in its debt may not suffer the losses that were initially predicted. However, Jefferies isn't completely out of hot water. At the end of September, Knight Capital Group KCG suffered a $440 million loss from what it called a technology issue, and Jefferies & Company was one of 6 firms to invest equity valued at $400 million to prevent Knight Capital's possible bankruptcy. Jefferies and the Blackstone Group BX took control of the most potential shares, meaning that they have the most to gain and also to lose from the deal. Although its investments thank you for trying verbose. This recording will go away once the product has been purchased. Knight Capital might not be as worrisome as its stake in Europe's debt crisis. Cautious investors should be wary of Jefferies' financial choices. 4. Netflix NASDAQ:/NFLX. What we said then, in the third quarter of this year, Netflix knocked the wind out of its own sales by increasing the price of its combination streaming movie and mail-in DVD service by 60%. As a result, 800,000 users canceled their subscriptions. Netflix then added to consumers' ire by limiting its streaming media to one device at a time. Netflix stock, which had thank you for trying verbose. This recording will go away once the product has been purchased. Enjoy the 2-year climb from the beginning of 2010 to a peak of more than $300 per share in July 2011, has nosedived to around $70 per share. While this means the saner price-earnings ratio than July's 80, the mail-in DVD company still faces substantial threats. For one, big-name competitors like Apple and Amazon NASDAQ:/AMZN have caught up with Netflix's formerly unique business model and are nipping at market share. There are rumors of Netflix selling its streaming service to the highest bidders, and additional rumors of a Securities and Exchange Commission investigation. Where is this thank you for trying verbose? This recording will go away once the product has been purchased. All going to end up. At present, it seems as though even management doesn't know what happened. Netflix has had an up and down year so far. While Netflix performed well in the early months of 2012, its stock price fell sharply in the summer months when analysts said the company was struggling to compete with its many rivals. Its high level of international spending was another factor weighing the stock down. This month is marking a sharp turnaround for the company, as reports of increasing customer satisfaction are inspiring more faith in its "Thank you for trying verbose." This recording will go away once the product has been purchased. Future performance. In light of the positive consumer feedback, analysts are beginning to wonder if thoughts of Apple and Amazon's threat of competition were overblown. Last week, analysts from Citigroup and notable hedge fund manager Whitney Tilson reiterated the company's buy rating, which is raising investor confidence. Netflix's year-to-date performance is up around 5%, but there are still some concerns about whether its international investments will be worth it. Netflix bulls might be laughing now, but they are still far away from converting its bears. 5. Green Mountain Coffee Roasters. Thank you for trying verbose. This recording will go away once the product has been purchased. NASDAQ:"GMCR What We Said Then." Greenhorn Capital hedge fund manager David Einhorn, whose fund enjoys a 25% average return, is best known as the guy who shorted and publicly denounced Lehman Brothers in 2007. Will Einhorn's latest target, Green Mountain Coffee Roasters, end up as a horticultural Lehman? In a presentation, Einhorn made the case that Green Mountain not only has an unsustainable business model, but that something smells like a rat in Carrot Land. In Einhorn's analysis, the company's lack of transparency and disclosure, peculiar relationships with quasi-captive distributors that led to inflated "Thank you for trying verbose." This recording will go away once the product has been purchased. Sales numbers, and heavy insider sell-off smack of funny accounting. Green Mountain CEO Larry Blanford denies it all. Whether Green Mountain Coffee Roasters is a good bet remains a heavily disputed topic. At one point, Green Mountain had beaten analysts' quarterly estimates by 10% to 36% over the year, as the Motley Fool's Rick Aristotle noted. Einhorn himself remains short Green Mountain Coffee Roasters, for reasons that won't play out until next year. Although his investors already celebrated one victory this fall when, as Minneapolis' Michael Como reported, Einhorn's very ugly and "Thank you for trying verbose." This recording will go away once the product has been purchased. Very public campaign against Green Mountain Coffee Roasters culminated in the massive gain for his investors as the former momentum favorite crashed and burned. In the November report, earnings came in at $0.47 per share, beating consensus estimates by a penny, and revenues rose 91% to $712 million, missing Wall Street's expectations by about 6%. Only time can tell what will happen to this once caffeinated stock. What happened? Well, time has spoken. 10 months into this year, Green Mountain Coffee Roasters is much worse off. To date, the company has suffered "Thank you for trying verbose." This recording will go away once the product has been purchased. A 49.52% decrease in stock price, and has been falling regularly. Einhorn is still on the company's back as well, most recently speaking against them at the 8th Annual Value Investing Congress. In his speech, Einhorn noted Starbucks' NASDAQ:"SBUX initiative to enter into Green Mountain Coffee's key business segment with its new product, the Verismo, an espresso maker that can double as a coffee machine." He also criticized Green Mountain's aggressiveness on capex spending, despite its plans to reduce it in the future. While normal capital spending is 3.3% of sales, Green Mountain's spending is "Thank you for trying verbose." This recording will go away once the product has been purchased. Over 9%. Other troubles for Green Mountain Coffee Roasters include the recent loss of its patents, and the loss of key partnerships through licensing agreements. Einhorn believes that these contracts will be renegotiated with less favorable terms for Green Mountain. In addition, he believes that Kraft NASDAQ:"KRFD will soon enter the market via its Maxwell House brand, adding even more pressure to a company that has to deal with Dunkin' Donuts.